Hey everyone, today we're diving into a topic that is arguably the most important life skill you'll ever learn. Financial literacy. Here's the truth. Most of us spend our entire lives working for money, but very few of us are ever taught how to make our money work for us. We wake up, go to work, earn a paycheck, and repeat. But what if I told you there's a better way? In today's world, financial products have become incredibly complex. Credit cards, insurance policies, investment schemes. The options are endless and often confusing. Unfortunately, fraudulent Ponzi schemes are more common than we'd like to admit, preying on people who simply want a better future. We all dream of a comfortable retirement, traveling the world, or simply not worrying about bills. But that requires moving beyond just saving money to investing with a purpose. The goal of this video is simple: to help you understand your personal finances so you can achieve true financial well-being and freedom. Let's start with the absolute basics. What exactly are savings? In simple terms, savings represent the surplus money left over from your income, like your salary or wages, after you've paid for all your expenditures. Think about your monthly routine. You get paid, you pay rent, buy groceries, fill up gas, maybe grab coffee a few times. Whatever is left over, that's your savings. Think of it as the cash sitting in your bank account that you can grab whenever you need it. Need to buy groceries? Access your savings. Medical emergency? Your savings are there. This is what we call liquidity, the ability to access your money instantly without any hassle. Savings carry almost no risk because they're typically held in bank accounts that are insured and protected. However, here's the catch. While your savings are safe and accessible, they're not really growing. In fact, with inflation eating away at purchasing power, money that just sits in a savings account is actually losing value over time. That's why understanding the next concept is crucial. Now, if you want your wealth to actually grow, you need to understand investments. Investment is the act of taking your savings and deploying them into various financial products, like shares, mutual funds, bonds, real estate, or even gold, with the expectation that they will earn you higher returns over time. Instead of your money sitting idle, it's actively working to generate more wealth. Here's the key difference you need to remember. Savings are for liquidity and short-term needs. They're your safety net, your emergency fund. Investments, on the other hand, are for growth and creating assets that generate future income. While savings might earn you 1 or 2% interest in a bank account, investments have the potential to earn significantly more, sometimes 8, 10, or even 15% annually. But there's a trade-off. Investments come with risk. Their value can go up and down based on market conditions, economic factors, and company performance. This volatility is completely normal and is actually part of the wealth-building process. The key is having the right balance between savings and investments. To truly understand your financial health, you need to know what you own versus what you owe. Let's break this down. Assets are items you own that have economic value, things that either put money in your pocket or have the potential to increase in value. A classic example is a fixed deposit at your bank. Other examples include stocks, mutual funds, real estate property, or even a business you own. These are things working in your favor. On the flip side, we have liabilities. These are things you owe to others. Debts and financial obligations. If you've taken a car loan, that's a liability. A personal loan? That's a liability. Credit card debt? Definitely a liability. Even that EMI you're paying for the latest smartphone is a liability. Here's the wealth-building secret that rich people understand. Your net worth is simply your assets minus your liabilities. If your assets are worth 10 lakh rupees, but you owe 8 lakh in loans, your actual net worth is only 2 lakh rupees. If you want to fund big goals like buying a home or paying for higher education, focus on building your assets while keeping your debt under control. Let me ask you something. Have you ever noticed that you can't buy the same amount of groceries today with 500 rupees as you could 5 years ago? This phenomenon is called inflation, and it's one of the most important concepts in personal finance. Inflation is the steady rise in the prices of goods and services over time, which causes the purchasing power of your money to decline. Your money doesn't actually disappear, but what it can buy becomes less and less. Here's a real-world example. A Vada Pav that cost 2 rupees 5 years ago might cost 7 rupees today. It's the exact same snack, but your money has lost its strength. This happens with everything: movie tickets, milk, electricity bills, even haircuts. Everything gets more expensive over time. The average inflation rate in India hovers around 6 to 7% annually. This means if you have money sitting in a regular savings account earning 3% interest, you're actually losing purchasing power every single year. To beat inflation, you must aim for what. So what exactly is this real rate of return I just mentioned? It's actually quite simple, but incredibly important. The real rate of return is your investment return minus the inflation rate. Let me give you an example to make this crystal clear. Suppose you invest money in a fixed deposit that gives you 7% annual returns. Sounds pretty good, right? But wait, if inflation is running at 6% during that same year, your real rate of return is only 1%. You're barely staying ahead. This is why so many people who think they're saving money are actually losing wealth over time. Their savings aren't growing fast enough to keep pace with rising prices. This is exactly why investing becomes crucial. You need to invest your savings into products like equity mutual funds, stocks, or diversified portfolios that have the potential to earn returns significantly higher than the inflation rate. Historical data shows that equity investments have averaged returns of 12 to 15% over long periods. Yes, they come with short-term volatility, but over time, they're your best weapon against the silent thief called inflation. Albert Einstein reportedly called compounding the eighth wonder of the world. And once you understand it, you'll see why. Compounding is the process where you earn returns not just on your initial investment, but also on the returns that investment has already generated. Let me explain this with an example. Imagine you invest 1,000 rupees at a 9% annual return. In the first year, you earn 90 rupees in interest, bringing your total to 1,090 rupees. Now here's where the magic happens. In the second year, you don't just earn interest on the original 1,000 rupees, you earn it on the full 1,090 rupees. This cycle continues year after year. Your money starts earning money on its earnings. Over 40 years, that tiny 1,000 rupee investment could grow to over 31,000 rupees. The longer your money remains invested, the more powerful compounding becomes. This is why starting early is the single best thing you can do for your future self. Even small amounts invested regularly can grow into substantial wealth. Now, let me share a simple mathematical trick that will help you quickly understand the power of compound interest. It's called the Rule of 72. Want to know how long it takes to double your money? Just divide 72 by your annual interest rate. That's it. For example, if your investment earns 6% per year, it will take roughly 12 years to double your money. 72 divided by 6 equals 12. If you're earning 9% annually, your money doubles in about 8 years. 72 divided by 9 equals 8. This simple rule helps you quickly compare different investment options. Let's say your bank offers a fixed deposit at 4%. Using the rule of 72, your money would take 18 years to double. But if you invest in mutual funds earning 12%, your money doubles in just 6 years. That's 3 times faster. This rule isn't perfectly precise, but it's accurate enough for quick calculations and planning. It's a fantastic tool to help you visualize the long-term impact of different investment choices and understand why even small differences in returns matter tremendously. Let's talk about a strategy that removes the stress of trying to time the market perfectly. It's called Rupee cost averaging, and it's a game changer for regular investors like you and me. Here's how it works. Instead of trying to guess when the stock market is at its lowest point, which even experts can't do consistently, you invest a fixed amount at regular intervals, regardless of market conditions. For example, you decide to invest 2,000 rupees every single month in a mutual fund. Some months, when the market is down and prices are low, your 2,000 rupees buys more units. Other months, when the market is up and prices are high, the same 2,000 rupees buys fewer units. Over time, this automatically averages out your purchase costs. You end up paying a moderate average price instead of risking buying everything at a peak. This strategy protects you from the emotional rollercoaster of market fluctuations. You don't need to watch business news every day or panic when markets drop. You're systematically building wealth through discipline and consistency. Managing your money is a journey, not a destination. It requires patience, discipline, and the right knowledge. By understanding the fundamental difference between saving and investing, respecting the erosive power of inflation, and leveraging the incredible force of compounding to your advantage, you are setting yourself up for a life of financial freedom rather than a life shackled by debt. Let me leave you with a powerful analogy to solidify everything we've discussed today. Think of your financial life like planting a fruit tree. Savings are like seeds you keep in a jar. They're safe, protected, and ready to use whenever you need them, but they will never grow into anything more. Investing, on the other hand, is the act of planting those seeds in the ground. It requires patience, and yes, the weather, which represents market conditions, might be unpredictable. Some seasons will be harsh, but over time, the power of compounding acts like the sun and rain, turning those small seeds into a massive tree that provides abundant fruit for years to come. That fruit is your passive income, your financial security, your retirement fund. Start planting today.